Hey everybody, Larry Luna here with Team Luna Homes, powered by Cross Country Mortgage and brokered by eXp Realty. And today we're going to do kind of a Q&A. So I have summarized the top 10 questions that I get from buyers, actually first-time buyers that are looking to purchase their first home, not really sure about how the process goes. And these are the typical questions that I get from those first-time home buyers. So I thought I would share some of those. So I wrote those down. I'm going to share them with you. And first is, well, first and foremost, I mean, how much house that I can afford. And there's a lot of factors into that. First of all, it's based on the price of the home. Second, then it's based on your income, your debt, your credit score, your minimum monthly debts as far as your minimum monthly payments that are required to make on each of those creditors. So all of those factors kind of come into play in addition to how much money you're actually putting down, because that actually determines the loan amount that you're actually going to finance. So if you combine those all together, those are typically will give you the specific answers in terms of, or at least a range or an estimated range of exactly how much home you actually afford. Number two, what's the difference between a pre-qualification and a pre-approval? I get this one a lot because they hear some things from certain friends, family, or social media, and then they hear something from realtor partners and lenders. So they're a little confused. So the difference between a pre-qualification and a pre-approval is basically a pre-qualification is the verbal information that's given by the consumer, by the client or borrower, to the lending or the mortgage loan officer. And they take that information and they crunch those numbers together and they say, yeah, based on what you're telling me, this is about what you would qualify for, what your monthly payment could potentially be. Pre-approval, on the other hand, is based on verifications through documentation. They don't go through to a third-party verification or to underwriting at that point, although that is an option that they can do. But in terms of the standard pre-approval, you say how much you make, you say what your debt is, you say what your credit score is. The mortgage loan officer is then going to get a copy of your pay stub, a copy of your W-2s. They're going to run your credit. They're going to verify everything that you're saying and that it matches in potentially the numbers that they're looking to use to qualify for. So that's the difference between a pre-approval and a pre-qualification. Number three, how much do I need for a down payment? Again, that kind of determines based on the type of loan product that you use. And some have minimum requirements of 3.5%, such as an FHA loan. You can go as low as 3% on a conventional loan. You can go as little as 0% on a VA loan if you're eligible, and the same with a USDA loan if you are eligible and the property is eligible. So it really kind of depends on the loan product that you're using, your available funds that you have to put down, because inevitably the amount of money that you want to put down is going to directly affect the loan amount that you're financing. So next, what kind of loans, mortgage loans are available? Well, there's your standard loans that everybody uses, your conventional loan products through Fannie Mae or Freddie Mac. There are government programs such as FHA, VA, USDA. Those are the standard five that most borrowers will kind of fit into. There are these loan products called non-QM products, which is a non-qualified mortgage product. They don't follow the standard regular rules as your Fannie, Freddie, VA, FHA, and USDA. Those are typically managed and underwritten and conditioned specifically by the lender. It's their loan product. They set the standards. They set the requirements. So those can vary from non-QM product to non-QM product. The next is, what will be my monthly mortgage payment? Again, so a good mortgage lender is going to break down those numbers for you, and they're going to give you what your principal and interest will be, what your property taxes will be, what your homeowner's insurance could estimately be, what your mortgage insurance, if needed, would be, and then any HOA that might be affiliated with the property. You combine all those together, and that would be your monthly payment. But the lender will break that down individually into details specifically for each category of your mortgage payment. Now, remember, the mortgage lender is only responsible for the principal and interest, right? The amount that they're lending, the interest that they're charging. The property taxes are basically based on the county and or city that the property is located in. Your homeowner's insurance, that's something that you choose as you shop for a home insurance carrier. And the HOA will depend on the property, if it requires an HOA or an association that you have to pay to monthly or annually. And if there's mortgage insurance is required on any loan that is put down less than 20%. So if you put down less than 20%, then you're going to be carrying the mortgage insurance. So all of that can be broken down by the mortgage lender. The next is, what credit score do I need to qualify? Again, that will impact your eligibility and will determine your payment. So that being said, it solely is dependent on the loan product that you choose. Again, this is something that the lender can go through with you step by step and tell you the minimum credit requirements for each typical loan program that's available to you based on your qualifications. From that, you need to keep in mind and in perspective that the credit score meeting the minimum credit score only qualifies you for that loan. The higher your credit score, the better your interest rate, right? So the interest rate is based on the credit score of the borrower. You may meet the minimum credit score requirement, but you're going to get the low end of the totem pole in terms of interest rates versus somebody that might have a 740 or a 780 and something along those lines. So that's something that you want to keep in mind. Next, what documents do you typically need to apply? Well, those are pretty standard. Pay stubs, W-2s, tax returns, and bank statements. Copy of an ID. We just want to make sure that you are who we are running in terms of qualification. But that's the basic standard. The more current, the better, because things can change from week to week or month to month. So we want to make sure that we have the most accurate and current information. From that, lenders will take and verify that with a third party, whether a manual employment verification, they'll run the W-2s through the tax records. But for the most part, a pay stub, W-2s, and bank statements, along with your tax returns if needed, are typically the items that are required to do a pre-qualification and pre-approval. Are there any first-time buyer programs or grants? Yes, there are. There are several, in fact, in not only nationally, but there are typically programs locally, statewide, that are utilized for the benefit of first-time buyers who, for the most part, typically may not have quite enough of funds needed for their down payment and their closing costs or their cash to close to get into their first home. A lot of these programs will allow down payment assistance that can help with the down payment and part of your closing costs. Some are repayable loans that you can use. Some are grants that are, as long as you meet certain requirements, you don't have to pay that money back, and that you meet those certain requirements and guidelines for those down payment assistance programs as well. So yes, there are several different loan programs that are available specifically for first home buyers. Next is typically, well, what is the interest rate that I will get? And is it a fixed rate or an adjustable rate? Well, again, let me go back to the credit, because the credit basically determines that you can meet the minimum credit score requirement for the loan program that you're utilizing, but typically the higher the credit score, the better the interest rate. That's what's going to determine what it would be. And you have that option for a fixed or an adjustable. The lender should really kind of go over those options and weigh those pros and cons to see if those fit the goals of what you're trying to accomplish in a mortgage to finance the purchase of your home. But typically, it will be based off of your credit score. And from that credit score, the down payment, whatever your debt to income ratio is, that combination of factors will determine the best interest rate. And the lender should really give you somewhere between 3 to 5 different loan options when you are ready to lock in your interest rate. Now, keep in mind, as a disclaimer as a lender, the interest rate that they're telling you on day one may not necessarily be the interest rate that you're going to get and lock in when it's time to sign your loan docs. Interest rates change and are a variable factor on an hourly and a daily basis. So you have to keep in mind that what they're quoting you is what it is as of that moment, that day, based on the information that they have available. 2-3 weeks down the line, once everything is verified and you want to lock in your interest rate, when you get to that point, the lender will rerun a pricing for that particular day based on your updated loan package, and from there we'll give you an update of interest rate options that are available based on your criteria and your qualifications. So just keep in mind that what you're quoted in the beginning is probably accurate what it is at that particular time if you locked in your loan at that particular moment, versus if you decide to move forward. If you finally find a property, you actually move forward, you sign your disclosures, and now it's time to lock in your interest rate, and we're talking a week or 2 or 3 weeks down the road, that rate could be better, worse, or the same, but you have to keep that in perspective. Last question is, what are closing costs and who pays them? So closing costs are basically the fees that are affiliated with the purchase of your home. So you have to keep in mind there are different factors, entities that are involved in the purchase of a home. Obviously, your lender is going to have their origination fee or their fee for doing the loan, and that typically includes services such as processing writing. It could include an application fee. It could include a credit report, but the lender is going to have their specific fees for you. Title or escrow or attorney, depending on the state that you're in, whether you use one of those three, whatever their fees are to be the go-between between the purchaser, or so the buyer, and the seller. That title, escrow, or real estate attorney is going to be the neutral third party that processes the transaction mutually between the two parties. So whatever their fees are for their services, that's also going to be included in your closing costs. Part of your closing costs include your prepaids and impounds, which are typically your property and or city taxes and your homeowner's insurance. And those fees will be added based on whatever home insurance policy you finalize and agree and want to utilize, and whatever the property tax rate is for that particular property, those will be included as well. So those fees are included, and part of those are your impounds in your prepaids. So those are fees that are typically part of your closing costs and typically needed as far as cash to close. Now, closing costs cannot be included into the loan amount on standard loan products. Those are typically out of pocket at the close of escrow fees that you have to come in with for your cash to close to get your keys. A lender should be able to break that down for you. Again, keep in mind the lender only has control over the lender fees. They do not have control over whatever title and escrow charges for theirs, or the real estate attorney charges for their fees and their services, whatever the prorations, taxes, insurance, prepaids, and impounds for your escrow account. All of that's calculated based off of the property tax bill and your homeowner's insurance. So they don't have control over that, but those are determined as part of your closing costs. So there's sometimes a misinterpretation that the lender is charging me all of these extra fees. The lender is just getting the fees from the county and getting the fees from whatever home insurance policy that you picked, including those in, subsidizing an impound account to put those into your prepaids, and then determining what those numbers are and then rolling them into your closing costs. So the lender only controls the fees that the lender is charging, not title, escrow, real estate, your prepaids, and impounds. Okay, those are the 10 most common questions for first-time home buyers that I get. So I hope that information was helpful for you. If you'd like to delve into it a little bit deeper and find out specifically what you're looking at, we can certainly do a soft pull pre-qualification, run through some numbers. If it's something that makes sense, if it gives you some options that you want to consider and seem viable before you start home shopping, then use the link below. Set up your no obligation one-on-one phone consultation, and we can go over those numbers specifically in detail, line by line, so that you clearly understand exactly what what the loan entails, all the costs are affiliated with, and how that results into your estimated monthly payment. So again, thanks for watching. Hope this information was helpful for you, and thanks for watching. We hope to talk to you soon. All right, take care. Bye-bye.